So I've been in my career just for so long trying to just dispel this notion that retail buys the top and sells the bottom. And I find that, it's largely driven by people who want to manage their money. But I find the easiest way to dispel that is just show them data. And so what we do is we created an index that looks at the top 100 stocks at Robinhood, and it's very democratic. So if I have $20 million or $200, if 10% of my portfolio is Apple, that's an equal weighting. And we take those 100 stocks on a monthly basis, and then we overlay them on the NASDAQ and on the S&P. And we just show it and say, we give a little color and we just say, here's what they're rolling into. This is what they're doing. And here's how they're performing against the broad-based indices. So it's aggregated, so they can just look at in aggregate, how is Robinhood doing? And for 2 of the last 3 years, they outperformed the market.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to this episode. We've actually got a really special episode today. Today, we're going to be joined by a special guest. He is the Chief Brokerage Officer at Robinhood Markets. Prior to joining Robinhood, he oversaw the strategy and deployment of initiatives for trading at TD Ameritrade. He also served as a member of the company's senior operating committee, which shaped the strategic focus of that organization. He focused on teaching the next generation of investors and championed the creation of the TD Ameritrade U program to bridge the gap between academia and reality. Prior to his role at TD Ameritrade, he was responsible for the development of new trading tools and technology enhancements for the Think or Swim Inc. trading platform, and he holds a BBA in risk insurance and marketing from the University of Wisconsin, and he holds FINRA Series 4, 7, and 24 licenses and is an active board member of the Cara Collective. Please welcome Steve Quirk. Hey, Steve,
Thank you.
Thanks for joining us. Yeah, thank you.
Oh, thanks for having me. That's a lot of billing. We have to make this an amazing segment. Otherwise, I won't live up to it.
Well, you have had quite a career shaping the options industry, and I'm super
I
excited.
think you and our careers have intersected multiple times.
Yeah. We've had some fun together through the years, I think, huh?
We have, yes. I
So,
appreciate you having me.
yeah, I certainly appreciate you taking time out of your schedule and joining us. I think our listeners are really going to love this. So, Steve, how'd you get into option trading? Where'd you get your start?
I got started in 1987, and I actually didn't start at the CBOE. I spent most of my career at the CBOE, but I started at the CME,
Oh,
and I started in the S&P option pit, not the S&P futures pit, which was much bigger, but it's a little satellite pit that was right next to the S&P futures pit. And I was there for probably, I don't know, a year and a half or 2 years, and then moved to the CBOE and spent, many years there, almost 20 years on the trading floor in various capacities. But yeah, I started the week of the crash and really the week after, because I don't know, people don't remember that one of the consequences of the crash was they shortened the hours to 9:30 to 1:30.
huh.
And because there was just so much uncertainty, people didn't understand clearing firms, brokerage firms, individual market makers, market making firms. They were all very, very unsettled about what was happening, and nobody knew who was going to survive, who wasn't going to survive. It was quite a interesting time. The bad news is, of course, there was people got harmed, but the good news was, some of the things that came out of it, the whole concept of skew and just the way, limits were implemented and some of the other things. It feels like everyone and every episode drives some positive developments to ensure that that episode doesn't repeat itself. However, some variation of that episode always seems to come afterwards.
Yeah, yeah. History doesn't repeat itself, but it sure does rhyme, right?
It does, exactly. Well said.
So, from your seat at Robinhood, you see millions of trades.
Hmm.
What are retail traders consistently getting right and what are they consistently getting wrong?
It's an interesting question because it depends on, the answer to it is different depending upon, my career at TD Ameritrade and Schwab. The average age of the customer was like 60. So their behaviors, like what I always say is there's a lot more similarities than differences. However, the differences are kind of important. And one of the differences that exists with the Robinhood customer base, which average age 36, is they're in the early stages of their investing career and they're still accumulating wealth. So they have a more aggressive stance. They should, because they know they've got 30 to 40 years of investing left. And so when there are opportunities and dips, they're aggressive. And I think what often gets reported is, well, they don't know, they haven't lived through some of these prolonged downturns in the market. That's true, but I don't know that they'd change their behavior even if they had lived through them, because again, I just read an article a couple days ago where they said if you had been investing since, I can't remember the timeline, it's like 1970. If you had been continually investing on the best days, when the best drops happen, you would have had X return. If you were continually investing at the worst days, you would have had an amazing return. Not as good as the best, of course, but if you had sat and tried to market time and et cetera, you would have woefully underperformed. And that doesn't mean that people don't still like to take some portion of their portfolio and trade the active names and generate income and do all the things that we'll talk about. It just means for a lot of people, they have a core portfolio that they kind of, for lack of better terms, set it and forget it for the most part. So I think that what we see is exactly that. I think the other thing that's really fascinating is like retail customers now across the board have become savvy portfolio managers. So they'll take an occasion like when the tariffs were first introduced, see really popular names drop 40, 50%, dive in. And then as they get some appreciation, they'll roll out of them and roll into something that's underappreciated. And this is the behavior of portfolio managers, which individuals are doing. And I think that's largely due to the amount of information, education, and content available so that people have a good understanding of how to be effective in the market.
Interesting stuff, especially that they have that discipline to keep investing.
Well, if you think about the number of times, I like to say this because I think it's kind of funny to say. I mean, retail customers have bailed out the market a couple times now. They bailed it out during COVID. They bailed it out during the tariff. They're bailing it out.
Huh.
And in times past, they probably couldn't have done it because they weren't as big of a component in the market. Now, like Henry Schwartz has some presentations on volume. I don't know if you've ever seen them.
Oh, yeah.
They're amazing. Like the percentage of retail has gone up. And I think there was a lot of conjecture that what happened around COVID would be a blip. It was just an acceleration and that growth continues. So as they become a bigger force, they can move the market. And that's kind of cool.
So, how much of that do you think is a result of, I guess, kind of, I don't know, what I'm kind of translating as the discipline of buying those big dips or whatever
Yeah. Mm-hmm.
versus education or just more speculation or just there's more money out there that needs to get put somewhere? Like, yeah.
I think it's actually a little bit of all of the above. That is the one thing that I have this conversation with a friend of yours as well, JJ.
Uh,
The point that we always make to each other, especially at a young age, you got to put your money to work. Like you're not going to put it in a bank where you're earning 0.1%. Like that is a recipe for disaster. Everybody knows that. So yeah, I can find funds and things that yield a little better, which is good. In times where you're really uncomfortable, you should do that. If you're not comfortable, then you should do that. But in the long run, people have money and they got to put it to work if they want to achieve the goals of buying a home or sending kids to college and all the other things that come up. So I think that's a component of it. But I also think it is the education. I think people understand it. Now it's very easy to look back in history. It's very easy to see the power of compounding. It's very easy for people to understand these things, and they can be on a more level playing field with the professionals, which is, I think, what every one of them strives to do.
Mm-hmm. Well, this show is mainly about trading the wheel.
Mm-hmm.
So our audience uses covered calls, cash secured puts.
Yep.
What percentage of your retail customers trade the wheel?
I don't know that we know what percentage trade the wheel, because sometimes you back into the wheel, you know what I mean?
Mhm.
Yeah, I mean, we have people that are aggressive put sellers, and I think they don't ever want to have to take that stock and create the wheel, but sometimes they do. But I love talking to people about that strategy because I think it's just such a cool and effective strategy. And I remember when we used to do you and I have both taught, when we used to do some teachings on it. I remember the example that we used quite frequently was GE from the 2008-9 period, where it got as low as, I'm going to be off of my numbers, like 570 or something like that. And it came from, levels that were crazy. But the premiums and the volatility was so high in that individual name because it was moving. Like, just using the wheel in 9 months, you had that stock for free. You'd sell puts for 50 cents, I mean, and sell the call for 50 cents, and like you had that thing for free. And that's like an amazing example of, when done effectively, how powerful it is for that strategy. I'm sure you guys talk about it all the time, so I don't think we need to talk about it. But the one thing I would say, though, because I know a lot of people who do use the strategy, and the one thing that's kind of cool is they all have different variables that they plug in. I want X amount of premium. I want this distance, from strike price. I want, all the variables that are going to dictate what you're going to find attractive. But I also think there's another funny element to it, which I've found myself in my own career. There are instruments which people are comfortable with, stocks, ETFs, whatever, that they do it with, and there are ones that aren't. And I've had that in my career. Like, there are some names that I don't know what it is. I just can't get it right. So, I mean, like, the stubborn kid from Wisconsin in me says, I'm going to keep going here until I figure this out. But then one day I have this this day of reckoning that says, you know what? Why in the hell am I fighting this? Why don't I just stick with the ones that I keep making money in and keep doing that? Because it's probably a bad analogy, but I have three kids. It's kind of like, I understand this one does this a little better, this one does this a little better, and this one does this a little better. Let them all be their own.
Yeah, yeah,
And
yeah.
let's capitalize on what they do well.
Yep, yep. So you mentioned you've seen some traders who sell puts but really don't want to get assigned.
Hmm.
Do you see more traders using options for income,
Yeah.
or are they really just directional bets disguised as income?
Oh, I think it's both, actually. I think there's both. And, I mean, the huge growth in short dated options kind of illustrates both. Like, I love the topic of short dated options because, the critics will be like, oh, the exchanges created these products so that they can just have more and more of these expirations daily and get more people to trade and all these things. And I'm like, the exchanges created products that the customers want.
Yep.
Like, if I'm a person who has 60% gains in Apple, and I know exactly what day their earnings is, which is could or could not jeopardize that, but I don't want to take a taxable gain, I can protect it on a 1 day basis. Like, it's a good instrument for that. And it was designed with customers in mind. I think what gets lost in that conversation is, they're like, oh, these are short dated products. Like, you should be holding things for X amount of period of time. I'm like, every single product, every single asset class has a shorter duration than it did 20 years ago. And part of the reason for that is these sectors come so fast and leave so fast. 2 years ago, we didn't even know what AI was, right? Now it's the hottest thing on the market. And I'm not going to prognosticate that it won't be around in 5 years. It's going to be transformational, but I'm using it as an example of things like the average stock doesn't come into the Dow or S&P or NASDAQ and sit for 100 years the way they used to.
Yeah.
So you have to be a lot more nimble with your investing. Otherwise, you're going to be stuck. And so I think, the exchanges and market participants understand that and they try and create products and technologies so that people can be more successful.
Yeah. Yeah. And, I mean, you don't get that kind of volume, 50% of the market volume, if people don't want those products, right?
Exactly. Yeah. Yeah. We had, I don't know, I'm sure you read the journal, Gunjan. Yeah. She did a segment on short dated options. And she's like, it was really good and fun because she's not really an option trader. So we got her set up with her account. The journal funded her, and the deal was, I think they gave her $500. If she made money, it was going to a charity. If she lost the money, well, it's a lesson learned. So she played around with them and she wanted to do it herself. So we left her alone. We just helped her set it up the way she wanted it to be set up. And she ended up making money. I think she made like 1,800 bucks or something like that. I can't remember the article to say. And so she donated it, of course. And her, she was on X and she, was putting blurbs about it. And then her mom responds and says, "Keep doing it." And I said, "Always listen to your mother. Always listen to your mother." It was a good example, but the conversation I had with her, which was really kind of fascinating, was it's kind of like speculating or gambling. And I'm like, I have a struggle with this. Like, tell me when it's short enough that it's considered speculating or gambling.
Yeah.
Like, is it a week? Is it a month? Is it a year? Like, I mean, we say long, everybody buy and hold. Oh my God, those people are amazing if they buy and hold. They have to buy and hold for 20 years, then they're cool. But if you buy and hold for a year, it's uncool. Like, I just don't. I think people get to decide their own investment duration timeline. And for the people that are judging them, oh well. That's the one thing I love about real passionate retail customers. They hear all the things people chirp about them, and they're like, at the end of the day, they don't give a crap what people think.
Yeah. 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 Yeah.
Especially if they're successful. I mean, you talk to them all the time. The successful ones, they have conviction. They're not going to be derailed because somebody is telling them they shouldn't be doing something some way.
Uh-huh. And yeah, like you talk about buy and hold. I mean, how many stocks out there are just like Apple, like since inception, just like this great company? I mean, you mentioned GE before. I mean, they had a
Hmm.
history of raising their dividend every year for like 100 years or something.
Yeah. Hmm.
Now we're at
Hmm.
oh, geez. And even though these are short-term options, I mean, they can be part of a long-term plan still.
Yeah. Yeah. I always laugh at the people who are like, well, you understand 80% of options are expire worthless. I'm like, you're assuming people buy options.
Yes.
Like, I want an option to expire worthless if I'm selling it. Like, I don't know why we're using that as a data point as if everybody is losing money. It's the opposite.
Mm-hmm. So, one thing that has become really near and dear to my heart, I mean, especially with the wheel, but it's extended into other parts of my trading, is really looking at things as return on investment. Do you think a lot of traders, just in general, think in terms of return on investment, or are they just still focused on, I made $2 on this trade?
No, I think with the tools that have been rolled out across brokerage, they get return on capital, return on investment, and they use it as a catalyst. That's one of the things that all the variables that we were talking about earlier,
Mm-hmm.
one of the things that people are very cognizant of. The problem, I think, becomes, market conditions change. So even when we talk to people about how to invest, we're pretty adamant that if you have a successful plan, when you get punched in the mouth, stick with it and be careful not to do too much moderating of that or changing of that. But there are times when, market conditions are become so different that, I mean, when the volatility spikes and seems like it lasts for about 30 seconds nowadays to 60, you don't need to put as much capital at risk to get the same return. So, you should definitely adjust that plan. You know what I mean?
Yep. Yep. All right. So here is one that I love to ask when I talk to people at brokerages. What patterns in order flow or behavior
Hmm.
do you see with your customers that you're willing and able to share with our listeners?
Yeah, yeah. I think one of the things that's most interesting, and it's funny because it's not just at Robinhood, it happens broadly across the industry. In times like during the tariff tantrum and times where things get quite volatile, we notice that customers have less conviction about individual names and more conviction about the market. And when I say the market, I'm using air quotes. Sorry, I know we're on audio. The market would mean broad-based ETFs. So actually, there's an increase in broad-based ETFs. And again, in talking to customers, essentially what they'll tell you is, I have more confidence that the market is going to bounce than an individual name is going to bounce because, there's a lot of variables that are probably driving that volatility. And so it's funny, as soon as you see that volatility sort of subside, and it happens quick now, quicker than in our day, you're in my day, you see people gravitate back out of the ETFs and back into the single names. And that happens across the industry because you'll see it. You'll see ETF percentages go up. There's also some level of, I'm guessing, some level of protection there too.
Mhm.
You know what I mean? By institutions and individuals, as I'm sure you're well aware, the easiest way for them to get protection is just get broad protection.
Yeah. Yeah. That's pretty interesting. Yeah. So, like, this is something that we dealt with on, the trading floor and such. But I wonder if you see this in retail. Do you ever see so many traders making the same trades that it crowds the trade?
I see a lot of people pile into something that they previously aren't in,
Hmm.
which is, so I don't know if I would call it crowding because I think these trades like markets can support it. But a couple months ago, silver, ETFs, silver, like that's never been at the top of our top 10. We have 27.5 million people. We're doing 10 billion in notional, and silver's at the top of the list. And then all of a sudden, energy's at the top of the list. And listen, we trade it across the board. You could trade silver on futures, you can trade it in ETFs, you could trade it in individual names. So
Hmm.
everything bubbles up pretty quickly. And to me, that's kind of fascinating to see.
Yeah, yeah. Well, what else is something that in the data that you see that a lot of our listeners might be surprised by? Demographics or whatever.
I think the thing that we kind of lay out, and we have an index we created. So I've been in my career just for so long trying to just dispel this notion that retail buys the top and sells the bottom. And I find that, it's largely driven by people who want to manage their money. But I find the easiest way to dispel that is just show them data. And so what we do is we created an index that looks at the top 100 stocks at Robinhood, and it's very democratic. So if I have $20 million or $200, if 10% of my portfolio is Apple, that's an equal weighting. And we take those 100 stocks on a monthly basis and then we overlay them on the NASDAQ and on the S&P. And we just show it and say, we give a little color and we just say, here's what they're rolling into. This is what they're doing. And here's how they're performing against the broad-based indices. So it's aggregated, so they can just look at in aggregate, how is Robinhood doing? And for 2 of the last 3 years, they outperformed the market. Now, we're very open to sharing that and we share it. And, you'll have people on a certain network that everybody follows look at it and say, oh, look at this month. They're down. They're down. Look at, they're underperforming. I always point out, hey guys, these people aren't investing for a month. They're investing for a very long period of time. Are they going to have a month where they underperform? Sure. But let's look back, take a longer look, a longer view, which is what they're doing. And I think they're doing quite well. So I think that's really cool and a powerful way to kind of point out that they are having success.
Wow. Yeah, that's pretty cool, man. All right. Do you think, I just love firing these questions.
Yeah, yeah.
Do you think option traders fare better in high volatility or low volatility regimes?
I think it's different. I think it actually I think there's a separation between people who have more experience and people who have less experience.
Mm.
What I mean by that is I think people who have more experience fare better in the very volatile times, and people who have less experience don't fare as well as the people who have as much more experience. I actually attribute that to their experiences. Like what we just talked about, and particularly lately, how quickly the VIX or any volatile instrument just goes like this. It's really quick. So, you have to capitalize on it in a pretty quick manner in order to take advantage of the elevated premiums. I think the people who haven't had as much experience, to them, it's more of a frightening environment, and that's okay. So they kind of step out, which is perfectly fine until they learn it. What we strive to do is through we're rolling out social tools, is help the people who have more experience share wisdom with the ones who have less experience, because people are very aspirational when they're trading. They want to get to the next level. They want to get to the next level. They want to have a better understanding, particularly on options, because there's so much to learn. Giving them avenues to do that, to learn from people who have more experience, I think is really beneficial. You and I have been doing this a hell of a long time. I will tell you, in some periods, like even like 2008 and 9, I was like, I'm spooked a little bit here, man. I remember when companies started going out of business, I'm like, whoa, whoa, whoa. I've seen movies. I don't know if I've seen this one before.
Yeah, yeah. So, you mentioned traders getting to the next level and
Yep.
getting the experience. Like what is that experience? What have you seen that separates traders who last from those who just, flame out or whatever?
Hmm. I think the people that sort of, we talked about a little bit earlier, kind of stick with a plan, are diligent in continuing
Mhm.
to work and learn, the curious ones. There's another thing we did, and this is all the way back to our TD Ameritrade days. We actually did this study on people who were having success in the market. They have a level of optimism that's far above people who weren't being as successful or people who would leave the market. And I think that natural curiosity and natural optimism leads them to either instruments or strategies or areas of the market where there's an opportunity. And oftentimes those opportunities are where they can make some money. So if I just think about that anecdotally, in all my interactions with retail customers, it totally jives.
Yeah, yeah.
Totally jives. When you talk to people who are so passionate about what they're doing, like even if they hit a fork in the road and have an unsuccessful period of investing, they navigate it and get past it. And so I think that's actually a really interesting finding for us.
Yeah. That kind of reminds me a little bit of there was a movie a few years back, The Secret, and they interviewed all these kind of like a guru type like Tony Robbins,
Hmm.
and to find out, what is the secret to success, and it just ended up being a positive attitude,
Yeah.
optimism, like you say. So you mentioned before social tools. And so I'm wondering what recent improvements and such have you made to the Robinhood platform to help traders make better decisions, and what changes might be coming down the pipeline soon?
Well, I think one of the things that we've just started rolling out is a social tool. And like the problem with social, having dabbled around in social, both personally for, investments and looking for news and what's moving the market, and on built it for brokerage firms, is there's a lot of content in there that isn't about the market. And there's a lot of content in there that really isn't pertinent to what people are looking for. So the way we built it was, if you have a Robinhood account and you actually are making this trade and you are willing to share it or share your portfolio or whatever you're doing, then you knock yourself out. You're welcome to do it. If you're just in there bantering, that's okay as well. But you're not bantering about you made 1,296% on an investment, because that's not happening. Like this is meant to not be a political thing. It's meant to be market based, which I think people want. And we also don't want to be a pump and dump message board. So we're preventing those things, but it's a great avenue. Think about it. We have 27.5 million customers, and half of them are brand new to the market. So for them, all they want to do is soak up knowledge from people who have been doing it longer. And, a lot of people really find it fulfilling to share that. I mean, the whole idea that it's a zero sum, like I can't make money if you're making money, it doesn't exist in the market. So you can easily share your wisdom with others and they can generate revenue and returns off it as well.
Yeah, yeah. How well do traders size their positions? This is something with our coaching that,
Yeah.
yeah,
Hmm.
yeah. What do you think about that?
I think people learn really quickly.
Mhm.
I think it used to be one of the things that used to dog people when they first got into the market. Oh my God, I love NVIDIA more than anything. I'm putting 98.2% of my portfolio in that. And look, it can work, but we all know it can not work too.
Mhm.
And so, appropriately sizing the investments and what you're doing in their portfolio is like the core of the things that we try to share with customers
Yeah.
as ways like what we always try to tell people is, we're a self-directed brokerage firm. We don't give people advice. We don't tell them what the market's going to do. We don't prognosticate. We just give them the vehicle, we give them the manual, and we give them as much information and as many maps as we can so that they can find whatever they need. But what we also tell them is, listen, we're kind of like pilots that are flying ahead of you. We know where all the turbulence are. I'm not going to guarantee you're not going to hit some turbulence, but we're pretty sure that we've mapped most of them out. And here's a map to tell you where they all are. I would encourage you to use it, and you'll avoid a lot of those turbulence, hopefully, and that'll be a much smoother destination.
Hmm. Hmm. Yeah, I've worked with students who they're like, oh, I'm a 5 lot trader, and
Yeah.
they'll buy 5 calls in Ford or 5 calls in, SPX.
Yep.
These are not the same 5 lots.
Yeah. Oh, yeah. Well, I mean, yeah, that's product selection is really cool. We go all the way back to the exchange with that too. Like, I mean, when the exchanges come out with new products, we generally are collaborating with them on those products and just giving them feedback on how are your customers going to react to this. And oftentimes our feedback is it's just too big. It's just too big of a product for our customers. Now, it might not be too big for a Schwab customer. Their account's a lot bigger than an average Robinhood customer, but we give them that feedback, and I think that's kind of super helpful for them because the whole concept of minis and micros at the CME that came from us. They're about to roll out single stock futures.
Oh,
We've given them the same feedback. They're too big, too big, too big of a product.
yeah.
There's rolling out 50 of them. They'll get traction, but I think the smaller version will get more traction.
Hmm. Hmm. Yeah. Well, makes sense. Makes sense. If you were advising an option trader today who wants to build long-term wealth and not just short-term wins, what would you tell them to focus on?
Long-term wealth,
Yeah.
look, I love the wheel. I use the wheel. I love it. And it's strategy. The only thing with the wheel that I find personally is it does take some time. Like, you know what I mean? If to learn it. And once you learn it, it becomes really easy to implement. But I just think you have to sort of commit to taking the time to learn how to do it correctly and
Yeah.
then to be on it, when appropriate. I think a combination of that with, again, a core portfolio and then look, I have a risk profile that's probably different than some people. I'm not afraid of naked options.
Hmm.
And I don't tell people to do what I do,
Hmm.
but I will, when the market has a big sell off, I will sell some puts. And when it has a big rally back, I'll sell some calls. And I love that position.
Yep. 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 All right. Well, we talked about things that traders should do. You mentioned a trading plan, which, yeah, man after my own heart for sure.
Yeah.
But let's talk about maybe a cautionary note. If you had to pick one common behavior that leads option traders to ruin, what would that be? What should they stay away from?
I don't know if they should stay away because it's a starting point for most option traders, but I wouldn't have my entire strategy be based on buying well out of the money calls.
Mm-hmm.
And it's appealing to people when they first get started because they see the risk reward. so they can see that they can make a very lot of money with a very small investment. But what they aren't looking at is the probability of that happening, which is very low. And so I think it's fine as a strategy if it's a component of your strategy. If it is your strategy, I just don't think in the long run, it's a very difficult strategy to be successful at if that's all you're doing. So I think that's one of the things. And look, it's fine. It's the way people start. So that's completely understandable. That's how you start learning about options. So that's understandable. But I think, and we see it, people start there, but then they gravitate into all the other strategies, which I think have much better returns over a longer period of time.
Mm-hmm. Well, there have been some great nuggets here. Thank you so much for sharing your insights and wisdom with our audience. So much appreciated.
Well, this is fun. Thank you. Thanks for having me.
Yeah, thank you very much for joining us. And that about wraps it up for this show. But before we go, make sure you're subscribed to this show in your favorite podcast app and leave us a comment. We'd love to hear what you think about the show. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.